This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Claremont.
Hello and welcome to Clear Money Talk. I am your host, Tim Claremont, and here with your wondrous, illustrious co-host, Mr. Tyler Andrews.
Thank you for an introduction, Tim. Like always, good to be here.
Always appreciate it.
We're excited.
We're in rare form today. We haven't recorded another Clear Money Talk for a little bit for us. We're on a Wednesday instead of a Monday. We normally do these on Mondays.
That's right.
And Tyler was generous enough to bring me a Vietnamese cold brew coffee today. So I am just like ready to curl up and sleep, even though that seems weird because it's cold brew coffee, but it tastes so freaking good.
That's like an oxymoron, you know? It's like you're energized, but you're sleepy at the same time.
It's almost like warm milk as a baby kind of thing.
Yeah,
you just want to. Anyway,
it is really good. If you haven't had one, get yourself one. You're missing out.
And we don't have a sponsor for it, which would be really cool if we had a sponsor for it.
That would be Starbucks.
But no, instead we're just
Pete's Coffee
promoting Vietnamese cold brew coffee because we got it at Trader Joe's. So
we did
right next to our office. That's where actually Tyler and Olivia were generous enough to acquire that for me. It was a special present. I was
You're
surprised.
welcome.
Thank you for that.
More to come.
More to come. So let's as the caffeine starts to kick in, I'm sure I'll start to increase my speed of speaking. You can always slow this down, I believe. Usually you have the control for that as you're listening to this podcast, and or speed it up or pause it or skip ahead or whatever you want to do. That's the benefits
That's right.
of,
Tim and I listen to our audibles and podcasts on like 3 times speed because we're all about time efficiency, and the more info we can get in a short amount of time, that's what we're all about. But if you want to slow it down to listen to us, there's nothing wrong with that.
That's funny. Yeah, it's true. I feel like ever since I saw Neo in the Matrix, like I just want to plug in and then be downloaded and be like, okay, I know Kung Fu. Like that would be awesome. So I love speeding up those audibles in the podcast when I try to retain and learn information.
Nice
as far as
movie
today,
reference.
though, let's dive in. Let's start helping you out. We've been
monologuing,
having a good time.
Yeah.
You
Okay.
got me monologuing. Anyway, okay, let's go.
The movie references just keep coming. Okay. Topic of the day for all the listeners: how do I get out of debt? Question of the day.
How do I get out of debt? So a lot of clients actually come in with their kids having this problem. Some clients will come to us when they have this problem, but a lot of times when you're struggling with debt, you're feeling like there's nobody there to help you. And I want this podcast to be there for you so you can listen to it, so you can get a sense of help and know that we're not here to judge you. Like believe me, there's no doubt in my mind, I have seen more debt on certain individuals in certain circumstances than you have. If you want to set the new bar, great, call me and tell me about it. We'll see if you can set that bar. But stuff happens. You end up in debt, and trying to get out of it, it can just feel like you're trying to bail water out of a sinking ship, and there's just water pouring in over the sides, and you just know that thing's going to sink, and that can just be so emotionally stressful. So let's give you some real ammo to get you out of debt and figure out how does this work? How do you tackle that? So the first thing that's out there, and we're not attorneys. We can't give you legal advice. If you are so much in debt that you are truly sinking the boat, it's worth considering bankruptcy or actually speaking with making some kind of a credit compromise. All right. I would normally recommend talking to an attorney before you do anything like that. It will have drastic impacts on your credit score and affect your ability to borrow again. But it's not like you sunk the boat and drowned and died. It's not like that. Okay. There is a way to come back from bankruptcy or from a credit compromise or anything along those lines. So do not think that's the end of your life. That's not the case. There are ways to get back from that. But if you are able to figure out how to pay your debts off, it's just a function of saying, well, how do we pay them off in the fastest way? And is there such a thing as good debt and bad debt? I think that's worth discussing.
That is.
Especially in this new higher interest rate environment that we're dealing with. So many of our clients, one of their main objectives when they go to retire is to try to have their home paid off. That's sort of this old school mentality that's been around for a very long time of, I want to have my house paid off. Now recognize that just because your house is paid off in your retirement years doesn't mean you have no expenses for your house. You're still going to pay property taxes. You're still going to pay homeowners insurance. You're still going to pay for all of the various maintenance and repair expenses associated with your home. And you're still going to pay utilities and all that other stuff. So there's no real way to have something paid off that you live in because there's going to be other stuff that's going to come up. Having the mortgage paid off is a nice thing to have because it's usually a very large obligation for a lot of people.
Yeah.
But a mortgage, especially if it's at a low interest rate, like if you have one of those older rates of 2.5%, 3%, 4%, can actually be very good debt. And I would categorize that kind of debt as potentially good debt. In order to determine if you have good debt or bad debt, it all comes down to that interest rate. So you've got to know how much do you owe? This is the way you start with debt. You got to pull your head out of the sand and look at it. How much do you owe to each place? Write that down in one column. What is your minimum payment to each place? Write that down right next to it. What is your interest rate? Write that down right next to it. That's the very first start. If you've got all that down, you can see where you're at. Then it's time to say, okay, how do I start getting rid of this? And the trick to getting rid of the debt the fastest is pay the minimums on everything except the highest interest rate debt. Whatever has the highest interest rate is the one you want to give all your extra money to get it paid off in order to get rid of the debt as quickly as possible. And that maybe that seems simplistic, but it really is mathematically the way to pay the debt off the fastest. Now, there is another thing you can do, though, with your debt, which is to juggle it, to move it. Sometimes you'll have an opportunity to transfer debt from one place to another. Like you might have one of those credit cards where they offer the 0% interest rate for a period of time. And if you transfer a balance, and then there's sometimes a fee for that, maybe it's 3% or 4%, for example. And some people are really good at this. If you're good at math and you can do this stuff and it makes sense, you might already be playing this game, and that's fine. But a lot of our clients aren't great at math, and that's okay. Like that's what we do. So and unfortunately, a lot of the systems that are out there are designed to take advantage of the fact that you're not as good at math, and that's what we hate. So we don't want to see these systems taking advantage of you. And if you keep paying, as an example, let's say you have $20,000 or $30,000 of debt on a credit card, and let's say it's at 20% interest, which is very real right now.
Yeah.
Okay, your minimum payment on that might be something stupid like $50 a month. And you're thinking, I'll just pay $50 a month. That's all I got to pay. Or some negligible amount of money. You're never going to pay that debt off at that rate. And that credit card company is just going to love soaking you for 20% interest. If you owe $20,000 at 20% interest, let's do the math. 20% of $20,000 is $4,000. $4,000 divided by 12 is $333.33 a month. So you're paying $333.33 a month of interest just to that credit card for that scenario. Now, odds are that minimum payment is not $50 in that case. It's probably $350. So you pay the $333 in interest, maybe $17 down on that principal or $27 down on that principal, something along those lines. I guess 17. And you still owe almost 20 grand at the end of the month. So guess what? That credit card company gets to collect yet another $333 of interest from you the next month. Yeah. And because all you're doing is treading water. And what you're really doing is you're feeding that credit card company all of that interest money. So what if you took that same $20,000 of credit card debt and you relocated it to a place that had a 0% interest rate? Or maybe you have equity in your car. You could go to a local bank or a credit union and refinance the equity out of your car to pay off that credit card and potentially lower the interest rate on that debt. If you get that interest rate down from 20% to something along the lines of more like 6 or 7, which is possible in a car loan nowadays, let's call it 7% on that same $20,000, well, now you're only dealing with $1,400 per year of interest, right? Yep. 7% of $20,000. And you take that same $1,400, you divide that by 12, all of a sudden you're talking about $116.66 a month of interest instead of $333. How much did you just save? Well, the difference between $333 and $116, $220 a month, over $2,400 a year, because all you did was relocate the debt to a place with a lower interest rate. Mm-hmm. It's the same debt. You still owe 20 grand, but instead of 20% interest, you're paying 7% interest. So it all comes down to that interest rate. You've got to get your interest rates as low as possible on all of your debt. And then you pay the minimum on everything except for the one with the highest interest rate that you just can't get any lower. You pay that one off as fast as you possibly can. And the reason why there's good debt is because if the interest rate is less than what you would have otherwise earned if you invested the money, then that's actually not bad. That's good debt. Let's take you through that scenario. So pretend that you've got $1 million. Okay. And you could go to a bank and you can get a CD at probably about 5% interest right now. Yeah, you can find one. Right. Yeah. Okay, that's $50,000 a year on your $1 million of interest. Mm-hmm. Well, what if you owe $1 million on your home at 3% interest? Oh. You're only spending $30,000 a year of interest to the bank that loaned you the money for your home mortgage. Mm-hmm. You could take that $1 million, you can invest in a CD and make 5% interest. guaranteed FDIC insured, structure it correctly, right?
Yep.
And you get to keep the difference. That's $20,000 a year of revenue for you.
Nice.
Why would you take that CD, liquidate it, and pay off that home mortgage at 3%, and then just give up that extra 20 grand a year that you could have otherwise had?
Huh?
So good debt is when they're charging you an interest rate that's lower than what you could otherwise earn safely. And right now, there are safe interest rates that are paying you decent returns in a FDIC insured protected capacity with very little to no risk in a lot of those kinds of accounts. And you may have some of those grandfathered mortgages or real estate debts or other kinds of debts that are below 3 or 4%. And if you have an interest rate below 3 or 4, it's okay to pay the minimum on that for a very, very, very long period of time, as long as you're being smart with the rest of your dollars.
Yeah.
So I know it's a lot. Let me let Tyler kind of summarize, because I just threw up.
You love doing that. You're like, I'm going to take all the good
for
stuff.
it, Tyler.
Here, Tyler. I'm going to leave you with the slim pickings
pick up
here.
the dregs, my friend.
Yeah, thank you for that.
You're welcome.
No, I'm just I hope the listeners just deered in the headlights like as much as I did right there listening to you, because you brought up a lot of key great points. And it's funny, the debt consolidation method that you talked about, where you're paying the minimum on all the balances and paying the highest, extra per month to the highest interest rate. There's actually a slang for that. It's called the debt avalanche method, where you're, it's like an avalanche where you're paying the highest first and going second, third, fourth on the interest rates. There's another debt consolidation method called I believe the debt snowball method, where basically it's a little bit reverse, where you actually pay off the lowest balance first, not taking into consideration the interest rates, but paying off the lowest balance first, and then you go to the second lowest balance, pay that off, and it's a snowball effect. And the reason people like to do that is because it boosts motivation. It feels good to accomplish something. You pay off one, you're like, okay, I'm motivated. I want to pay off the next one now. And motivation is a huge factor in paying off debts, because
Totally fair.
You can get so underwater that you just lose so much motivation. You're just like, I just want to give up. I don't want to do this anymore. I don't even want to go to work in the morning, because this thing is just controlling my every second of my mind capacity, my mental well-being, and everything else. And that's a true thing that's happening to a lot of people, even right now. And there are ways to get out of it, which Tim went over a lot of different methods. It's just finding the right method for you that makes the most sense, that's easiest for you to pick up and run with. And there's people you can talk to about it too. Like us, we talk to clients all the time about this stuff and help them try to figure out the best method for them. So that's me picking up the slim pickings after Tim ate all the good stuff.
Oh man, I tell you, it's like the nucleus of the nachos.
Yeah,
Just went in there and just grabbed the nucleus.
The
good
chip
stuff.
with all the guacamole and salsa on it.
Yeah, it's all right. It's the jalapenos I was trying to protect.
That's what you're going for.
You can't handle all that spicy, so it's like I got you.
That's
back.
true. Yeah, I need mild salsa, man.
All right. Actually, I love that. I'd never heard the term avalanche method and the snowball method, but you're absolutely spot on. That makes sense. That snowball method, I think I can really easily visualize the analogy of that. And what you said is so on point. A lot of times financial advisors, myself included, can get in your head about the math. And the math is, I get it. Logic, the Vulcan way to solve this problem is to pay the minimums and everything and pay all the extra on the highest interest rate item because it will solve the problem the fastest. But it's a non-emotional approach. If emotionally, you got to get some of those lower debts paid off so that you feel better about working harder, about putting extra money towards the debts, then actually that motivation might even be more significant. Because in the Vulcan scenario, if you were going to pay $500 a month, but in the snowball scenario, you're going to pay $1,000 a month, you actually would have paid it off faster in the snowball scenario by motivating yourself to put more money towards the debt. So that is a really, really important differentiation, and I'm grateful for Tyler communicating it that way. And sometimes the stability of your cash flow really need to give consideration to that. If you have a short-term income stream, like maybe you have seasonal income or you have a job for now that's paying you pretty good money, but you don't know how long it's going to pay you good money, that's another reason to pay the snowball strategy, pay off those low balances that have those minimum payments, because when you get those paid off, it'll decrease your overall minimum required payment. So if your income goes down in the near future, your minimum, if you really have to scale back on the extra payments you're trying to do, your minimum will be lower. And that's another good thing to keep in mind. That's a benefit of the snowball method, especially if you don't necessarily have stable income. But if you do have stable income and you're just trying to figure out the mathematical way to do it the fastest, and there's a definitive amount of money you're going to pay every single month, no matter what, that's what you're paying, no more, no less, mathematically, the avalanche method should pay things off a little bit faster for you. And always, in either case, snowball or avalanche, moving debt from higher interest rate to lower interest rate is always a good idea.
Yes.
It's always a good idea.
Yeah.
And maybe the question is where, some clients might be curious, or listeners might be curious about why is an interest rate lower on some things and higher on other things? Right? We take that for granted right now.
Yeah.
Do you want to tackle that question, Tyler?
Yeah. I think the most basic way to explain it is there's secured loans and unsecured loans. Unsecured loans are things that probably the most common is like a credit card. It's an unsecured loan because there's no asset that's backing that loan that the credit card company has given you. When you use a credit card, the credit card issuer is giving you money to pay for whatever goods you're spending that money on. You're not spending your own money until you pay it off. You use your own money to pay off that credit card loan. Well, what happens if you don't pay off that credit card? What does the credit card issuer have to come and take from you? They don't have your house. Your mortgage is an asset-backed or a secured loan because they could seize your house if you don't pay your mortgage payments. Or if you have a car loan, they can come and take your car from you. You've seen videos on the internet of the tow truck rolling up and they just pick up your car and drive away with it, and the person's running out of their apartment saying, "Whoa, that's my car. What are you doing?" They're like, "Well, you didn't pay your car payment on time, so it's ours now." So those are all secured loans. And then you have unsecured loans, things like credit cards, and there's nothing to back it. And that's why with credit cards, you usually see higher interest rates associated with those debt balances because the credit card issuer is taking more risk because they don't have as much recourse if you just get up and leave and stop paying them. So.
You nailed it, man. Dude,
please
so
elaborate further.
That was so
just
good.
Mic drop.
Mic drop. Well done, Tyler.
Yeah.
Totally solid. Totally on point. Secured and unsecured loans is spot on. And it really comes down to what are you putting at stake to borrow that money? And if you're not putting anything at stake to borrow that money other than your reputation, which might mean a lot to you, and that's cool. I get that. But at the end of the day, the interest rate is higher if you don't have anything at stake that they can seize and resell. Yeah. So that would be an unsecured debt. Which is why if you have equity in a home or equity in a car or equity in something that people are willing to loan you money and you're willing to stake that item against that, you will typically get a lower interest rate. So that is a source for you to look to pay down some of the unsecured debts if you know for sure you are going to pay off your debt. If there's a chance that you are going to declare bankruptcy or you're going to go into a consumer negotiation situation, you don't want to move unsecured debts to secured debts, or that means that you're going to lose whatever that asset is that you put up to secure the debt. You're going to lose the car, you're going to lose the house, or whatever that situation may be. So if you're just trying to figure out how do I pay this off as best I can, and you know you're going to pay it off, you're never going to declare bankruptcy or going to the end of that, definitely give consideration to using some of the equity and some of those financeable assets where you can borrow against them, secure the debt, get a lower interest rate, and use it to pay off some of the unsecured debts. That's another way to decrease the interest rate. Yeah. But overall, just have a plan, look at it. I think the ostrich syndrome is the biggest problem with the debt situation out there.
What's the ostrich syndrome?
Well, if you've ever seen an ostrich, they stick their heads under the ground, right? So it's everybody out there with a lot of debt. I would say 9 out of 10 of them have their head in the ground. They don't want to even look at it.
Yeah.
They want to hide from their debt. They don't want to. Just taking out a sheet of paper and a pen and writing down how much you owe to each place you owe it, what your interest rate is, and what your minimum payment is. You're tackling the ostrich syndrome right there. You're saying, I'm going to pull my head out, I'm going to look at what I have, and I am going to see what I have going on so I understand what it is. And you don't have to be good at math to be able to write down what you owe, how much your minimum payment is, and what your interest rate is. That has to be provided to you by all the places that you owe money to. So just collect the information and put it down on one sheet of paper so you can see it. If it goes on to 2 or 3 sheets of paper, you probably need some help. We can help you. That's okay though. But yeah,
there's no shame in it.
No, nothing wrong with that at all.
I think Tim said it earlier. There's finance in a vacuum and there's finance in real life where your emotions come into play. And when you get to the mathematical, the economical standpoint of paying off debts, you want to pay off the highest interest rates first. You want to tackle it from that approach, positive arbitrage between how much I can earn versus how much I'm paying in interest rates. But when you take the emotional approach into it, sometimes that stuff doesn't matter as much. Sometimes it just matters about how do you feel? Can you sleep at night? Are you drowning in debt and it's just eating away at your physical and mental well-being? And all that stuff's very important too. And
Yeah.
I think it's worth mentioning, you know?
You're on point. And there are actually a lot of debt crisis centers that you can lean into. Like
That's a good point.
Consumer credit counseling. There's a lot of nonprofit organizations out there that'll assist you. And they have more experience than we do in this. Like, right, we're financial advisors. We manage money for people. We help people grow their assets. It's just that oftentimes we find our clients will come to us, or they'll bring their kids to us, or other friends to us that have a debt situation. We understand how to tackle it. We'll point them in the right direction, but it's not a service we provide regularly here at Clear Financial Partners. It is something we like to be aware of and try to help in a pro bono way. I hope that this particular podcast is helpful for you, and there are definitely many, many resources out there. Don't let that debt get you down. Don't worry about it. If you're bailing water and the ship is sinking faster than the water you're able to bail, there are people to help you bail, and just get some help, because that's okay. It's okay. We don't want you to drown.
Nope. Sure don't. Just the answer?
Okay, just the answer. So just the answer.
How do I get out of debt?
How do I get out of debt? So 2 methods were discussed today, I would say, to get out of debt. All of them are paying attention to your interest rate and your minimum payment and your debt size. So make sure, step 1, write down all the debts that you owe on a sheet of paper. Then step 2, write down all of the interest rates that you're paying on that debt. Step 3, write down all your minimum payments on that debt. The avalanche method says I'm going to pay the minimum on everything except the one with the highest interest rate. I'll pay all my extra money to that till it's paid off, and then I'll avalanche into the next one with the next highest rate, and so on and so on and so on. The snowball method, take that same sheet of paper and you just say, what's the smallest balance I owe? Let's get that one paid off so we get rid of that minimum payment. It'll improve your minimum payments. Your minimum payments will go down. It'll improve your motivation, because you'll see some of the debts fall off the page faster. And you can tackle them in the order of the smallest first, as far as the smallest amount you owe. But mathematically, the avalanche method, using the same amount of money, will pay off your debts faster than the snowball method will, if you're going to make the same payments in either of those scenarios. And always be open to relocating your debt to a lower interest rate. If you can move the interest rate down on any of your debts, that's going to improve your overall situation. Finally, good debt is if you have an interest rate that's lower than what you could otherwise earn by investing the money. So if you owe 3% interest, for example, on a debt, and you can invest it at 4 or 5%, you might not even want to pay off that 3% loan. You pay the bare minimum on it so that you can invest your money and make the difference on the extra higher interest rates. There are safer ways to invest to earn 4 to 5% right now in this environment, in things as protected as CDs, savings accounts, and money markets. You can check with your local banks for some of those options. Yeah. That, I think, is just the answer, or about as tight as I can come up with it.
That was great. I'm just thinking in my head, why do they use snow analogies for the debt consolidation methods?
Probably because you feel buried by an avalanche, or you're going to be buried by the
bullies
snowball
just throwing snowballs at you. It's like,
I like the snowball concept, because as you think about it, it's like you're building the snowball with larger and larger payments. As you take the payments away from one of the debts, you apply bigger payments to the next ones.
Yeah.
So you're kind of building your payments up by making bigger snowballs as you move the debt off of one payment to another.
You're rolling it down the hill, the proverbial snowman. You roll it down the hill, it gets bigger and bigger. And
right.
Yeah.
And then the avalanche, I could see that where it's like, by tackling the tallest part of the mountain first, the highest interest rate one, you just tumble it down and you hit from the top of the mountain all the way down as the interest rates are a little bit lower. So that's kind of the way I picture it.
Yeah, me too.
But that's just whatever. It is what it is. Analogies are great. What do they say? Pictures worth 1,000 words, and analogies worth 1,000 pictures.
That's right.
Hopefully you remember the avalanche and the snowball method. Get yourselves out of debt, and remember, it's okay to have some good debt. Debt can be actually a really good way to build net worth. I don't know a lot of extremely wealthy people who have no debt. It can be a very powerful tool for individuals, and managing your debt is a big part of managing your wealth. And we definitely use that with our thought process when we're working with clients.
100%. Well said.
All right.
You ready for some trivia, man?
Let's hit it, man. What you got?
All right. I just got a simple one for you. One trivia question today. Let's see what you can do with it.
All right.
You ready?
Yep.
Okay. What food manufacturing company, headquartered in Battle Creek, Michigan, uses several animal mascots to sell its cereals, such as Newton the Owl, Tony the Tiger, and Rooster named Cornelius?
Oh, my goodness. Okay. So it was long enough that I think I was able to get there. Like at the end of the day, if the location of it, like if you're listening to this podcast and you're from, was it Lansing, Michigan? Is that what you said?
No, Battle Creek.
Battle Creek, Michigan. Okay.
Yep.
If you're from there, you're like, oh my gosh, I know what that is. And I'm like, okay, I'm not from there, so I don't know what that is. And, and then cereal and everything else. And some of those names, like whatever, the Rooster, like I don't know about the Rooster.
Cornelius the Rooster.
Cornelius the Rooster. I don't know about Cornelius the Rooster, but I do know about Tony the Tiger.
Yeah, you do.
And Tony the Tiger is on Frosted Flakes. And Frosted Flakes, I believe, are made by Kellogg, not Post. So I'm going to guess that it is Kellogg.
Well done.
Nice.
The Kellogg Company.
Kellogg Company. There we go.
Headquartered Battle Creek, Michigan.
You think it's funny because I said Kellogg, not Post. Of course, I always think of Post as the other big cereal brand provider. I think Raisin Bran was Post. I love good Raisin Bran. Actually,
you would, man.
I know I would. Whole Foods actually has this really good. It's like this pumpkin seed Raisin Bran that's not like, anyway, it's tasty. A little bit of oat milk on that. It's good cereal.
Sounds good.
All right, now I'm getting hungry.
And with that being said, do not go into debt shopping at Whole Foods.
True.
Shop at whatever grocery store is best for your budget.
Fair. That's fair.
But
choose the places wisely. Spend your money wisely. Always spend less than your paycheck. Manage your dets well, and and call us.
Give us a call.
503-579-1000 is our phone number. Give us a call.
That's right.
Check out our website, clearfp.com, Clear Financial Partners. We've been doing this for 27 years. So 1997, 27 years now. And we're still kind of sort of hip and kind of fun.
I think so, man. We try to keep it fun. Finance is sometimes objectified as being boring, but we try to keep it funky, fresh, funny, fun.
Hope you're having a good time listening to us. If you made it this far, thank you for listening.
Seriously. We look forward to the next one.
Yep. And that brings us to a close, guy. Okay. And this episode of Clear Money Talk is now coming to an end.
Investment advisory services are offered through Clear FP Advisors, LLC, or registered investment advisor. Securities are offered through Clear FP Securities, LLC, member of FINRA IPC. Exposure to ideas and financial vehicles discussed should not be considered investment advice or a recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments may fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Timothy Claremont is licensed in your state, please contact his office. Clear FP Advisors, Clear FP Securities, and Clear FP Life LLC are not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide tax and/or legal advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Clear FP, LLC NPN number 194283777 and or Clear FP Securities NPN number 197499604. Any discussion of general investing strategies or specific securities are for conversational purposes only and should not be taken as a guaranteed endorsement or recommendation.